Thanks, John, for setting that very high expectation. So beware high expectations. And actually, that's actually a very good segue into this session, because I think the world we live in now is what I would call the post-hype world. And I think as a broad trend, we're seeing that we've moved from over the past decade, from what I would call an era of irrational exuberance towards some of these energy technology startups, to a much more realistic world. And I think the world of irrational exuberance was driven by the sense that we're running out of energy, the sense that oil prices were going to go from 100 to 200, and we were at peak oil, and of course driven by the environmental agenda. We're now in a world where those expectations have been tempered. Capital, which had been abundant, and is now much more, I think, much more discerning. And we have some folks here who can talk about that. I think people have much more realistic expectations. And I think that the focus has shifted really from, and that's embodied in this session, shifted from disruptive innovation to enabling or incremental innovation, which is really the way of the world. That's how this energy system works. So I think our purpose in this session is to have a very open discussion. I'm going to invite each of our entrepreneurs to ask them really to talk about, first of all, their company, what's their incremental innovation or disruptive innovation as they see it, and what trend does it tap into? What is the mega trend that they are participating in? And then finally, what is their biggest challenge and their biggest hurdle? And then I'm going to turn to the wise men, the investors and professors, to really react to that, respond to that, and ask them what advice they would have for the entrepreneurs and what observations they would have in terms of insights on how the experience represented on the left-hand side of the panel reflects really the big trends and the big issues that they're dealing with every day in their either academic work or investment as investors. But before going into that, I just want to acknowledge this session and really MIT. I think this kind of forum really reflects and embodies what MIT is at its heart about, bringing together people who have this sort of focus, this energy, this intelligence in practical ways addressing the technology future and the energy future. And really, to some extent, the fact that there are so many spin-offs and so many startups that come from the ecosystem that is MIT, bespeaks volumes about what the institution is about. So hats off to Trond and the rest of you. I want to give a shout out to Lou Carranza. I think he's here. He's wearing a tie that looks very similar to mine, which is an all of the above tie. You can all look at it afterwards. And also want to acknowledge Emily Martin, who's here somewhere. There she is. She's at Sierra now, or IHS now, but she will be joining the ranks of MIT come September at the Sloan School. So we're sorry to lose her, but our loss is certainly MIT's gain. So let me start with Dan Deal, alphabetically, and ask Dan to give a comment on Aircuity and what you're seeing out there, and what's your innovation.
Okay. I don't know if you can hear me okay? Yeah, okay. Well, Eric, I probably am we're not exactly a startup, so it may be slightly different, but we were about 6.5 years ago. We had only a dozen or so customers, but now we have actually 600 customers, approaching 600 customers. We're installed on 5 continents, 40 states in the U.S. And what we do is we optimize airside usage in commercial buildings, which equates anywhere between 30 and up to, for 100% outside air buildings, up to 70% of the energy intensity in a building. We recently were awarded Apple's new world headquarters, so that's a really exciting breakthrough for us. So we've been at it, but I've spent 25 years in the efficiency space, deploying innovative energy efficiency ideas to the market, and certainly I can absolutely speak to the fact that I think the two biggest things that both of those were themes here today The biggest challenges we face, or anybody faces, deploying new efficiency technology to the marketplace is financial solutions are a big part of that. And getting to the right level in the organizations to find out what the right financial solutions need to be and should be. And the second thing is just bandwidth. You can envision even our best customers have maybe anywhere between 50 and 100 different people pursuing them for efficiency, both supply and demand side. And typically, even our biggest and best customers, very few people. I was interested in the Saudi Aramco comment about having a team of 20 or so plus people that analyze maybe 1,000 deals. Most of these customers have one or two people in their or a few or handful, less than a handful of people that are analyzing and reviewing and testing and piloting new adoptive technology. And so we don't necessarily compete. We don't really have a competitor necessarily, but we do compete with all the other ECMs. So people are looking at lighting, they get distracted and they get focused on lighting, and they may do that for 2 or 3 years while they continue to waste an enormous amount on the air side. So, deploying things in parallel and getting customers to figure out and to be able to focus on that. So deploying financial solutions and helping customers with the analysis and the implementation really is what I see as being the biggest challenges in the industry for us, and it's what we've been working to continually break through in the marketplace as we've grown.
Just to be clear, when you say financial solutions, you're referring to, just to clarify what that means.
Well, we are, customers typically, they either buy an efficiency measure through a capital purchase, or they through a typical PO system on their capital side. The new solutions through the geo solutions and stuff that's Enlighted doing, and we're breaking ground on that as well, is more buying that through your operational, hopefully through your operational budget, and or the traditional way to do that was through ESCO. So no money out of pocket, do it through an energy services company, which also, by the way, is a great, especially for startup type companies deploying efficiency. It's a great. There are other avenues to piggyback on top of. To work with other energy service companies and the like to get installed into a project. We certainly built our company, Air Acuity, by working with a few handful of customers in the early days, really vetting our technology with them. University of Pennsylvania, Arizona State, University of California, Irvine, Michigan State, Eli Lilly were probably the cornerstone companies. We worked with them over the course of 2 or 3 years. And then we use reference selling. So when we sold, I was just at University of Virginia yesterday. When we talk to a new customer, we say, look, talk to all of our existing customers. Don't, we point to them. They love to share. They love to share best practices and help each other learn and deploy. So that's the way we kind of try to go to market today. But those early years working with those early adopters, if you will, when it comes from a marketing perspective, working with those early adopters and getting them to be the voice of what you can do for them is the key to success that we found.
So we'll come back to sort of some of the solutions, but let me turn to Ben and ask Ben Glass from Alteros Energies.
Sure. I'm Ben Glass, one of the founders of Alteros Energies, and I think we are squarely in the startup camp. We're still in the product development phase, and the Alteros was basically started to commercialize the world's first air-borne wind turbine, and we're a little bit of a strange fit for a incremental energy workshop because we're building flying wind turbines. But to your point about with the ecosystem we're in now having to be just doggedly pragmatic and realistic, from very early on in the process, we started the company in 2010 out of MIT. We had this focus on, while the sort of pie in the sky utility scale, we're going to solve the entire energy challenge is really exciting and attractive. We were 3 recent, college grads with a cool concept on a piece of paper, and that's not a path that you can take quickly. And so we set out to find the quickest path to market, and we've had been very focused on this for the entire time. And this has led us away from the utility scale power market where you have to be, 99% uptime, you have to be 3 cents per kilowatt hour. and we've gone to a very different market in remote power, where in many ways the threshold for success there is a little bit lower. We don't have to be at 3 cents per kilowatt hour. We can bring a much smaller product that's relatively more expensive and still be very, very compelling, because we've found the customers that are paying 50 cents or 75 cents per kilowatt hour. They're paying just enormous amounts. And so it's really, the challenge was finding a way to get a new technology to market where it can be competitive. And I think in our case, the solution was to find even if it's a niche market, find the customers that really, really need a new technology and a new solution to their alternative. I think I can talk a little bit about the sort of funding side of the startup, and especially when we started in 2010, it was not great time to be raising money, and we were in a technology that traditionally VCs just won't even touch, both wind and aerospace. It was kind of a double whammy. So we basically had to be really, really scrappy. Part of that was trying to find space that we could build some early prototypes. And as we started the company, we actually, with 3 other MIT startups, founded what has become Greentown Labs. And unfortunately, Emily Reichert was not able to be here today, so I have to give a shout out to Greentown. But so our approach was to basically pool resources with a bunch of other poor, starving entrepreneurs, in order to leverage what we could. And we were able to attract sponsorship. We got a bunch of free software and legal services. So there's sort of that side of kind of being scrappy and getting by with what you have. And eventually we got to the point where we were able to start attracting sort of larger angel investors and strategic investors. But it definitely takes a while, and so that's one of the constant struggles with doing a startup, and I think an energy startup in particular, because energy is it's very different from a high tech or a software company where things take a long time and a lot of money to build. So I think that's sort of our story.
Great, thank you. Let me turn to Justine. I'm going to get this wrong, but it's Kamisic, right?
Right, yes. You got it perfectly right.
Who's with Base Trace and is a fortunate late addition to the panel here.
Thank you.
Glad to have you.
I'm Justine Kamisic, CEO of Base Trace. We are a North Carolina-based company that is creating DNA tracers for complex fluid systems in various energy industries. So when we started off, we were focusing our tracer at being added to hydraulic fracturing wells, adding different essentially a different liquid barcode to different hydraulic fracturing wells, tracing where exactly those fluids were going and if they were ending up in people's drinking water. And at the same time, these companies have been very interested in tracing what exactly is happening to their individual frac stages and trying to be more productive and paint a better picture of what exactly is happening underground. So as we were focusing on that market, we actually got a phone call from a nuclear power plant saying that that they had an urgent need for a tracer that wasn't an additional chemical. It wasn't, for example, a dye tracer that could potentially cause issues to their chemical systems and could help them distinguish where exactly a leak might be occurring. So that was our very first alpha revenue. It was a very nerve-wracking experience. And we have since then been focusing on the nuclear market and been working with Dominion Resources to do some public demonstrations, and we'll be jointly presenting this at a workshop soon. So we are kind of in a very strange space in that we work in both oil and gas and in nuclear, but we do consider ourselves green tech or clean tech. So
which side of that is green?
Right, exactly. Trying to make these processes better, provide knowledge in spaces where we haven't been able to previously get that information before. So in a way, these sort of liquid barcodes kind of are along the trend of the sort of Internet of Things. But at the same time, it has been very hard trying to raise money. We are still very scrappy. Based out of North Carolina, there's not a lot of investing going on in that space out there. And it has been hard approaching investors saying that, especially those with a clean tech focus, many of them seem to be moving away, at least from what we found, from that space because they cite wind and solar and all these other previous investments that we've made in clean tech have been very infrastructure heavy. They didn't give us the returns that we wanted, so we're moving away from that. I think KPMG even recently announced that they're basically shuttering their future investments in that space, which is really unfortunate. Really, we think that companies like ourselves, as well as, for example, hydrophobic materials and technologies that bring these sort of significant incremental changes, bring more information to these companies, can be very versatile in the energy space. That is where smarter energy investment should be happening and should be focusing on, rather than having these investors kind of abandon that field entirely. So I think I can talk a bit more about some of our experiences, but
I can't wait to hear what some of the responses will be from from our panel, because I'm sure there are a lot of ideas that will be forthcoming. But let me first instead turn to Tom Scaramellino, who is with SS, and give a little. I hope I didn't.
I say ESES, but Jamie, you can call it whatever you'd like.
Okay. I was worried about your last name. I got that right.
You got the last name perfectly, actually.
Great.
First, make sure you get the cards of the two guys at the end there, okay? All right. Yeah, my name is Tom Scaramellino. I'm the president and CEO of ESES. ESES exists largely because 44 out of 50 states in this country now require that the electric and gas utilities that operate within their borders reduce the amount of energy that they sell each year. To do this, electric and gas utilities in North America spend about $12 billion a year, and that's growing at about a 20% annual growth rate. It's a very, very large market, and it's also growing very quickly. Unfortunately, a good chunk of that money they spend, about $2.5 to $3 billion of it, goes to try to upgrade building envelopes and HVAC systems, which is an incredibly costly enterprise to undertake given the current incumbent technology. Typically, I don't know if any of you have had an audit. Sanjay was talking about the audit he had from Next Step Living earlier in the day. But in the residential space, those audits can cost anywhere from $200, $300, up to $400. In the small commercial, up to the large commercial and industrial space, they can cost in the thousands or tens of thousands of dollars. And it's not just the cost that serves as a barrier. Frankly, most folks don't care enough to spend the morning home from work, to have to take off work so somebody can come with a truck and walk around their home with a thermal camera. Moreover, the analyses that are derived from human analyzed thermal imaging, even blower door tests and other similar things, are relatively subjective and often come across as kind of a sales pitch. And so what we've done here at ESES, and it's truly remarkable, what Sanjay, in 2012 really challenged these students at MIT to do, is essentially develop the capability to avoid humans being in the process at all, other than driving a vehicle. A human doesn't even need to know that the building's there, let alone know where the wall is, where the window is. Very similar to how Google has created Google Earth and Google Maps for us. ESES has done the same exact thing, except using infrared technology and a variety of other sensors, such that without any human intervention whatsoever, I can tell Tibor Todt that he has 2 major attic insulation issues on his west-facing wall, that he's got an air sealing issue on the window that faces the street, and that his HVAC system seems to be underperforming. And I don't need a single human being to be involved in that process. And so what we do is, rather than spending hundreds of dollars on a single home, we can get the same analysis across entire territories, entire cities, entire states in a matter of weeks at dollars per home. And our business is to sell that information as a data and software and marketing subscription service to electric and gas utilities. If you look at just National Grid right here in our backyard, they spent $90 million over the past 3 years trying to get all of you and everyone else in Massachusetts to do something to upgrade their homes. That $90 million represented about 50% of their residential energy efficiency spend. 50% of their money went to get you folks trying to, I just moved here, so it's not my problem. 50% of their money went to get you folks, it is now, exactly, to try to do this stuff. And unfortunately, of that 50% of the budget, only 15% of the savings came from that expenditure. And so they have a huge issue. And this is similar. Every large utility, every large investor-owned or municipal utility, whether it's electric or gas, has the same exact issue. They can't get these programs to be cost effective. They can't get people to participate. We dramatically reduce friction and enable that participation at mass scale so utilities can actually meet these ambitious goals the politicians are telling them they have to hit because of climate change and blackouts and brownouts and other things like that. And so our innovation really in the energy efficiency space, and largely due to Sanjay's impetus with his team here at MIT, is around teaching machines to see. And teaching machines to see in a highly intelligent manner using a combination of hardware and software that no one else, no company, no individual has on the world today right now. To be able to configure a combination of LiDAR, various optical and long-wave infrared camera units, odometry, wind speed, humidity, ambient air temperature, a whole host of sensors for the specific purpose of being able to upgrade, to deliver the intelligence to upgrade our building stock across 130 million homes and millions of additional businesses throughout the country. We are also exploring, and with some very strong early success, deploying the same technology to find streetlights that are out, to find transformers that are overheating on telephone poles. We work with the Department of Defense currently. They're our longest standing client where we do this to upgrade all the buildings on their military bases. We also provide the similar service to home services and materials companies. We currently work with the second largest manufacturer of insulation in North America. And we are dramatically increasing the amount of insulation that they're able to sell into homes. And so the technology is very powerful. And it all depends upon hardware and software combination where we can teach machines to see, and ultimately by doing so, they do a better job than humans, and we can dramatically reduce cost and increase scale to solve this major issue of upgrading the buildings in our country.
What would you say are your biggest challenges and hurdles?
The biggest challenge is teaching the machines to see better than humans. I can tell you, we've gone through 5 iterations of this hardware and software. You have an iPhone 6. We're at thermal imaging rig 5. Millions of dollars have been invested and spent trying to get this right from a commercialization standpoint. We've taken money from Exelon and DFJ and Mass CEC, and virtually all of that money has gone into solving minor problems that in and of themselves don't seem like they're important, but combined could potentially bring about the downfall of our technology. So, for instance, in hardware version 3, if 2 buildings were less than 2 meters apart, we mistook them for 1 building. Damn it. So now I'm telling Daraj about an issue that his neighbor Tibor actually has. Daraj is like, this isn't my house. What are you talking to me for? In hardware version 4, we failed to account for solar radiation effectively. So when I told you that you were losing $100 from your heating bill in the winter, it's because part of the sun's heat was still trapped in your building when I scanned. And I mistook that for a hotspot in your attic when it was really just your building emitting back the heat from the sun over the course of the night that it trapped. So addressing if we get one of these issues wrong, I can list dozens and dozens of these things that Sanjay in the lab got to punt over to the real company. So he had the easy job, frankly. But once we take this out to commercialization, dozens and dozens of these issues, if we get one of them wrong, I'm giving Tibor the wrong information. So you have to go 100%. That's by far the biggest challenge we face.
So you're pre-commercial at this point?
No, we're commercialized. We're working with large investor-owned utilities on the electric and gas side. We're deploying broadly with the DoD. We're deploying with home material companies. We are generating revenue and off to the races working with utilities and others.
So it's just good. I mean, what's interesting about this is that none of all these technologies. I mean, there are some breakthrough technologies in what each of you are doing, but a lot of this is what I'd call a disruptive application of existing technology. So
that's what Google would say. I think we're novel enough to be a completely different thing, but you're exactly right. It is an existing technology.
Not just yours, but I think all of many of these are like the tracing. I mean, a lot of this is applying things that have been developed through biotech, through sensing, through data, big data, applying it in innovative and creative ways to create what I would call an aggregate disruption in your specific marketplace. So just as a business model, to me, it's very interesting. People are no longer trying to reinvent the world of thermodynamics and physics and break all the rules, but actually apply things in practical ways. So just a general observation from all of you, very exciting approaches. But let me turn to our panel of wise folks and investors there and ask them for their reactions, advice that they would have to any or all of the entrepreneurs here. I think we'll start because Corey, we've heard. I'm not going to go in alphabetical order because We'll start with, I think, Sanjay, because you've been called out so much. What's your, first of all, you're not allowed to comment on this one, by the way. But what advice would you have for the others? And
Well, it's not so much advice as pointing out, I think, a fundamental flaw in our economic system where the incentives sort of work against, really innovative ideas. And, hats off to people like Mass EC. I think they lubricate a very, very important economic engine, right? You sort of, they skid the greases, so you get off the ground, you can do stuff. That's number one. Number two, unfortunately, I also feel that the odds are stacked against technology. It's a very strange thing. Things have started changing in the last 3 or 4 years, maybe 2 or 3 years. But if you do in technology, they use the I word against you, right? The infrastructure word. Infrastructure is sort of deadly. You don't invest in infrastructure. But the world survives with infrastructure. We're surrounded by infrastructure. So it's really very heartwarming to see a bunch of companies, not just these 4 companies, but also a bunch of companies in this room who have embraced the challenges and the romance of engineering to conquer major problems. And I guess the advice is, as Ben was saying, is to cross the chasm and to look for that one killer app, right, that makes you somewhat more palatable to an investment climate that may or may not be friendly. And it seems like all the companies here seem to have found that. Of course, you did it in spades, so congratulations on your growth, especially with the Apple thing. I'm a huge Apple fan, by the way. And so the appeal here, and really this is, I'm punting to people like Dheeraj and to Corey, is we need to find more test beds. We really do. And we need to find, and the United States needs to be careful, because if some other national government says we're going to do this, right, and we become the test bed, they could really fundamentally change the economics of startups and where you locate your startup and so on. So we need to figure out what those test beds are, and we need to make sure we leverage them efficiently. I'm sure I'll have other comments later, but I'll just stop there.
Yeah, I think you want to come back to that concept of test beds. I think that's a very interesting...
for us, for ESS, it was the DoD. The DoD provided a crucible for ESS to sort of take root. Actually, Mighty incubated it, and the DoD was our test bed.
Right. So. Well, we often say that the DoD has the power of procurement.
That's right.
As a result, they often are they actually contribute as much to energy innovation as sometimes the Department of Energy does.
That's right.
Just by the power of buying. But let me turn it to Corey and get your reaction to what you've seen and the comments from Sanjay.
Sure. Well, a couple of things that come to mind. Excuse me. One of which is, can there be something learned from residential solar with looking at energy efficiency? And what I'm thinking of is the solar cities, the sun runs that really offered a financing solution, right? So identifying the problem is the first step. Being able to fix it is another, and that requires, in the residential space, a capital outlay. Sometimes which it really isn't there, right? So I think the next step is there a financing solution where a fund could be raised with $100–200 million, similar to residential solar, where you're now doing the retrofit, doing the insulating, and then taking an energy savings component. Because arguably in residential solar, those have been by far the most successful companies. So, it sounds like a really promising step one. I guess the question is...
This is like a yield co.
That's right. So we'll retrofit your house with insulation, and we'll take half the savings for the next 10 years, right? And that provides an IRR to the fund financing that insulating, and provides you half of the cost savings over the life of your home.
And if I could add to that, that's sort of what companies like Ferrovial do to cities. It's a public-private partnership, and they sort of buy out the electricity bill for street lighting for 10 years, and they eat into the savings, so they share the savings. Right?
Sure.
It's the same thing, but it's good. Sorry.
Right, absolutely. So that type of fully integrated solution, I think, provides a mechanism for faster adoption. So, just a thought there. The other on the tracer company, it sounds fascinating, so I'm very keen on learning more. Tracers is a huge area, whether it's unconventional or in fields. So it's like predicting weather, what's happening in a reservoir. So being able to have low-cost tracers tell you exactly where, imagine on one end you've got injection wells, and on the other end of a field you've got production wells. Well, what happens in between is highly uncertain. So most companies are using tracers now. The challenge, I think, is twofold. One, they're relatively expensive, so they're only used when there are problems. Can you use them at steady state? And the other is distributed analysis, right? So I guess one of my questions is there a distributed, given the invention with the DNA mechanism, is there a distributed analytical form that could be used in conjunction with this? Because right now it's so archaic. There's a sample that's taken, it's sent back to a lab, that lab analyzes it, 2 weeks later you find out what's happening. You know, when you talk about digital oil field being responsive, that's not true if you have a 3-week delay before you find out what was going on last month, right? So, you know, I guess, is there an analytical solution that can be deployed in the field that would provide that faster feedback with your solution? So 2 thoughts there.
So it's the killer app, really. I mean, the one that came to my mind was oil theft. Tracing for oil theft is a huge issue, and you know, as an example, we've had many requests. Can you guys help us tracing where the stuff came from and where it's going? Yes.
Definitely.
So as an example, but there's I think why don't we turn to Diraj? Thoughts?
Yep. So I'd say one observation. I think you know, one of the challenges of the last sort of wave of investing was a lot of incremental innovation actually got invested in. There was Me Too, and it tended to be capital intensive, and that's why we are in this challenging environment where most people don't want to take that challenge on. I think you really need to find, as you put it, disruptive applications of existing technology. I would argue that most of the technology exists, just getting it to the market and solving the right problems. And what I refer to as product market fit is often never there for a lot of these companies. And they spend a lot of money trying to figure out their product market fit and then run into this challenge like, oh, what do I do now? I've run out of cash. And my investor's not willing to support me because we wasted a lot of time chasing after the wrong market applications of the technology. So I think advice to these folks is really focus on getting that product market fit right. In terms of sort of financing, I think energy efficiency, as Corey pointed out, I think financing is a big problem. And that's where, you know, we've invested in PACE, in Renovate America, which really solves that problem. They are the financing engine that is financing it. I think it is still challenging because there's a lot of regulatory hurdles to be overcome for some of the other states. California is always leading the way, and hopefully all the other states will mimic that and follow suit once it's proven and at scale. And it'll become mainstream, hopefully. So I think with some of the commercial side too, I think solving the way to get it paid for and eliminating all those friction elements that inhibit adoption of technology is where really the emphasis needs to be. And I think the tracer technology is interesting. I'd say, I just read a very interesting article for a biotech company that rebranded itself as a SaaS business, and all these Silicon Valley investors jumped right in, right? So maybe you should do the analytics of DNA tracing and say, I'm a SaaS company. I'm not going to sell you biomicrobes. I'm going to sell you SaaS solutions that are going to allow you to analyze your
add 10x
traceability, right?
Add 10x to your valuation.
There you go. And a lot of capital now starts chasing you, right? You just get that halo effect. So it's all about marketing and packaging.
Cloud trace.
That would be very popular in Silicon Valley, I'm sure.
So Rob, you've been studying.
I've got half an hour, right?
Yeah, you've been studying models of innovation, you know, and I'd love to hear your response and reactions to what you've heard.
Well, you know, at Mighty, we cover all skills. We're mostly active in this developed world environment, and much of what we do is connected with the oil and gas industry, although we also are connected with all of the renewables and connected to renewables research that goes on at MIT, which is a very large volume of research. But we're by far the largest lab at MIT. And we're funded mostly by oil and gas companies, believe it or not, and they're paying for all that work. And so I can sort of reflect on some of what you've said from that lens, and also from the other lens that we've developed in the last 3 years of looking at the developing world as a different context where things are being created to serve different market needs, which creates different design stresses and another sort of driver of innovation. And that's been enabled by the Tata Trusts, who funded the Tata Center, which lives within Mighty. So I would just rattle through, if I can, each company in order, starting with eSense, and just reflect a little bit on what you said and where it connects with different parts of the MIT innovation spectrum. I mean, in the case of eSense, I think what you described is half the problem, and I'm sure you recognize the other half, and the half you're addressing is how to eliminate the barriers that come from assessments of energy efficiency in buildings by essentially taking it outside the house and automating it. You're still faced with the problem of how you sell improvements, or how someone sells improvements and makes use of your data at the end of the day and monetizes this in some way. That is a problem that's being addressed by a group of economists here and at Berkeley and at Chicago now. Here they're led by Chris Knittel, and I'm sure you know Chris Sanjay, who's formed an organization called E2E, which is a big E, the number 2, and then a little e, which is doing a large number of social science experiments out there in the real world, investigating reasons why guys like Tiber don't deal with his west wall when it's in their economic interest to do so. and you know, it's a little bit mysterious, in fact, and they're learning a lot, and hopefully that will inform new policy. Moving on to air acuity, I liked this notion that what you're doing is removing stress from CapEx budgets and converting it to OpEx budgets. It's easy to see how that happens in the electricity industry, and Solar City in particular have been able to get customers of utilities to invest in, indirectly, solar panels on the roofs by simply picking up their electricity bills and sending them differences from time to time when they've accrued some sort of excess. Not so obvious how to do that in other areas. Heating, for example, being one. I mean, how do you get into the stream of the gas company that's providing gas to a house, and making use of that billing system? So I think that's a sort of a business innovation still to be investigated. Altera, or Alteris? Alteris. I have an off-grid house where I built myself a solar system, and I'm appalled by how expensive it is. So that's a hard market, and doing it with the wind is doubly hard. Someone mentioned the military and DoD. I guess maybe it was Jamie. It's an opportunity, clearly, for that sort of technology. I think another opportunity, though, and one where our colleague Dave Perot is operating, is in power electronics. So much of what's being done in off-grid systems, especially small systems, residential scale, and there are many of these and variations on them in the developing world where grids aren't fully developed, comes down to storage as well as power electronics. And what we have and what gets used nowadays in both areas is extraordinarily primitive. Lead-acid batteries still predominate in storage, and the kinds of power electronics that are used for inverters and charge controllers are sort of embarrassing to me as an electronics enthusiast, because they don't make use of really modern or innovative design techniques at all. Dave is pushing that along with really novel strategies for making magnetic materials and magnetic circuits in very compact forms, which lowers their cost as well as their size and creates possibilities like inverters on board panels. And I think you mentioned one of your firms doing that. They're also beginning to look at the possibility of implementing MPPT, maximum power transfer, from cell to cell on panels as a way of eliminating the inefficiencies that come from blocking parts of the panel either by bird crap or by shadowing from trees and so on. And this can have a really big effect on the efficiency of arrays with very little cost. So there are lots of things to be done in off-grid, and I think markets that are going to grow. As a private pilot, I don't like the idea of kites up there in the sky gathering power, but I'm sure that can be solved in some way, maybe in developing countries where there are fewer private planes. Base case, I hope that tritium leaks from nuclear power plants aren't a growth business.
Unfortunately, it actually seems like
they may be. They may be.
Yeah.
We've got 100 and some nuclear power plants in this country, and they are 100% old nuclear power plants. As a
Well, I
result,
presume the
That's the
market, you're looking at markets not only in the U.S., I presume, nuclear industry.
Yeah.
Yeah, definitely. We're very interested in some of the markets abroad as well, and also some of the power plants and maintenance of power plants beyond sort of after they shut down as well, because they have to be monitored for 50-some years or more.
Yeah. And the power plant operators resist doing it, as I'm sure you've discovered. The idea,
Well, there's a liability issue.
It's a, yeah. What liability? Yes, in fact, it's the federal government's
That's
liability.
true, yeah.
The market that you referred to, though, of monitoring production of unconventional gas and oil production, clearly is growing and very exciting, and there's enormous interest amongst the oil companies in techniques like yours. I wonder if, rather than looking at venture capitalists, you would instead be better to look at the companies themselves who typically do invest in these sorts of things. They do it at MIT, where there are a number of such projects going on. And there you might find an opportunity to A, get customers, or B, get sales of your technology directly.
Well, let me pick up on that and ask you folks, is that a model that you've tried, and what response are you getting?
So far, in terms of approaching strategics, we are getting some interest. There's a large company I can't really name right now that has a venture arm that seems interested. For the most part, they seem like they invest in much larger round sizes. So since we really don't need too much to build out and add capacity, and especially since we're looking at taking a business model where we sell to service providers instead of having to continue with direct sales, we can really reduce costs on our end and be very efficient with relatively little capital. So, so far, at least some of the venture arms that we've been talking to seem like they aim for much, much bigger round sizes than what we're going after.
So there's too much money out there to swallow a horse.
Right, exactly.
Are you finding the same thing? I mean, I know, Dan, you recently were involved in a fundraising exercise.
Yeah, it's always.
I know that because I'm in all disclosure, I'm an investor. So.
Yeah. Yeah, I mean, it was exciting to tell our story, but yeah, people have different appetites, and you know, it takes just a lot of work to find the right match, if you will, and so we were successful. Well, we will be as of next Tuesday, and but then, you know, once you have that capital, obviously that's, you know, use it wisely. The earlier comment I think about was so important is being focused. Somebody mentioned about focus. We have an enormous market. We estimate it to be $5 billion, and we are a really small company in Newton, Mass, 50 people, and you know, we're doing projects around the world, kind of like one at a time. But it takes so much discipline, because every commercial building is an opportunity for us. And you know, we do K through 12, we do healthcare, commercial buildings, universities, special purpose buildings, arenas. There's no building that I don't look at and say, oh, wow, we could really help them with the, you know, optimize the ventilation, the air side, efficiency, HVAC, energy spend in that building. But you only have so much time, so much bandwidth, so much focus. So picking the right customer, getting the right demonstration projects, and being really focused with the market, the best fit for your market application is literally the best advice I would have. We did that in spades, and we constantly have to say no to really good opportunities. And you have to fight as the leader of a sales organization or the business to say, no, we're not doing that. You know, and that just takes a lot of discipline. It's really hard to do. You're like, no, but I can sell that job, or I can sell this project, and you have to say, no, that's not what we're doing right now. We're going to do that. So I think that's tremendous advice to early stage companies.
Tom, are you looking for funding from venture, or what's your, is funding an issue for you guys?
So we've raised a couple of rounds. The company raised a friends and family round very early on in early 2012, then a venture round again later in 2012, and then another round last year. Company's raised a little over $11 million to date from some, you know, very impressive institutional folks. Most impressive among them, Mass CEC, of course, but also Exelon, which is one of the largest utilities in the world.
Knows where his bread is buttered. Take a bow.
DFJ, which is obviously one of the blue chip Silicon Valley VCs. A number of other venture capital firms have participated. So we are institutional money primarily at this point. That said, you know, the unique sort of issue with ESES is that, as Diraj said earlier, we are a SaaS company. We truly are. It's not a repackaging. It's not a remarketing. We deliver We deliver subscription products via software from a data and marketing standpoint to our clients. Those products have incredibly high gross margins for us when we deliver them. But that entire SaaS apparatus sits on top of a sunk cost of capital investment that is not quite what you were talking about in the early days of clean tech VC, where you're investing in solar or, God forbid, ethanol back in the day, if you guys remember that. I had a business plan for a $30 million ethanol company about 20 years ago, $30 million round around an ethanol company. Anyway, it's not quite that, but there is this notion of a sunk cost in order to deliver highly inventive and novel IP on the hardware side. But then once you get through that kind of and come out of the other side of it, the SaaS opportunity is just enormous, and we are incredibly differentiated because nobody's sitting on top of that unique hardware-based IP. And so our investors, we, frankly, took the same view as management, that the opportunity, should we cross that chasm, is so large that it makes sense to spend a little bit more money early on to get this right, focus on that differentiation. And today we're the only vendor in the world that can deliver this type of intelligence to electric and gas utilities, to federal agencies, to state agencies, to any actor that's concerned about building intelligence across a large territory. And that makes a few extra $1 million and a few years of hardware-based research more than worth it, and smart investors like ours tend to see that.
And good-looking investors.
And good-looking.
So, Ben, are you in the process? You said you're looking for capital now, or
so we closed the first large round with a strategic investor in November. So it was it was 4 years or so of.
Can you say who it is, or is it?
SoftBank, which is a big Japanese telecom company that has made a big push into the energy space around 2011, following the Fukushima disaster. So they took the Series A, and it's something that I think that from the entrepreneur's perspective, you've got to sort of balance how much money you raise, the dilution of your ownership, with the ability of that money to multiply the value of your company and allow you to start hitting bigger milestones faster. So that's sort of our trade-off. We kind of had a range of dollar amounts that we had a minimum that we needed to raise, but we were looking at a range because with more money we can move faster. And even though it has more upfront dilution, we can get to a point where there's real value in the company quicker. So it's hard to turn money down if it's on the table and if the terms are reasonable.
Mm-hmm. Oh, shucks.
They would say yeah.
Listen, I have about 100 questions, but I think I'm being advised, I think properly coached, that I should really shut up and turn it over to the audience, or this, not an audience, it's really more of a family here, for questions and comments and reactions. So are there some questions that folks have, would like to address, or some points you'd like to make? You can just identify yourself.
My name is Enrique Shada. I'm Tron's colleague. Actually, we used to share offices or be next to each other.
Sorry about that.
It's okay. It's all right. I speak in Spanish and speaks in his language, so we're fine. I just came from a conference, University Startup Conference in DC, and the National Venture Capital Association and National Angel Capital Association did some presentations, and they talked about how investment is great and all that, and they kind of showed the numbers, and in Silicon Valley, investments in IT are like double what all other investments combined. And obviously Silicon Valley in California lead the way in terms of volume, sheer volume of deals done. Now, and also we hear about this kind of lack of capital or patient capital or capital willing to go into the hardware companies. Now, everybody talks about the issue, but nobody kind of thinks about solutions and what's wrong with that picture. Everybody's like complacent that that's the way it is. Funds adjust themselves to finding those deals that are kind of going to get their return. So to the investors here or the startups, what have you seen in terms of the tide shifting? What changes need to be done? Is it at a political level? What do you see is missing, if at all?
Yeah, and just to expand that, does the venture model work in energy, and how? I mean, obviously you're here to speak to that. But what are the lessons of the last couple of years, and what do you see going forward for both Corey and Sanjay? I'll raise that, or Corey and Duraj rather. So.
I mean, I think the biggest lesson is there was too much capital that entered the space too fast and invested in too many Me Too companies that failed, right? And I think we're just clearing through that right now. It's taken much longer than any of us anticipated, sort of clear through that carnage. But in the process, good companies were built, right? Tesla, SolarCity, O-Power, Nest, all came out of the wake of well past when energy sort of collapsed in 2008, 2009. Most of these companies were formed right after that. So when you look back, and so that's what led to good innovation and actually product market fit and innovation that was disruptive application of existing technologies that have been successful. And I think we need more success stories. I think as more and more success stories come out, which are all in the making. We've got a couple here in Massachusetts that are doing very well. Next Step Living is a company that I'm very excited about to see how they do, and others that actually, when they get to the promised land, I think there's going to be more kind of belief that, okay, the venture model does work. I think we always joked with our LPs, there are going to be tourists who come into the space and leave just as fast as they arrived, and it's exactly what happened.
How much patience do those LPs have?
I think some of our LPs are very committed. I mean, most of them are still very committed to the space. I think it's just, the returns haven't candidly been there in the time frame that all of them had hoped for. And we are very hopeful that they will arrive. And, but it's not going to go back to what it was in 2007, where it was considered the third leg of the stool of venture capital, right? I think it's going to come back in a more modest way and, with financing and backing good entrepreneurs and good companies. So I think that's what it's going to need, is more success stories and more good companies being built.
So, Corey, you have a very long-term limited partner interest.
Right. Yeah, that's right. So we only have one person to make happy, which so far we've done. But I mean, I think the question of does energy fit the venture model is a really good one, because fundamentally what's different about the energy market is the capital intensity, the innovation cycles, and the adoption cycles. They're all longer. So when you factor all three in, the odds are stacked against you of being a successful company. So how do you get around that? I mean, I think what a lot of investors have done is say, well, we need to go later stage. We'll go post-prototype. And it will take 5 to 7 years to build a business, but it's an advantage technology. And they're essentially providing growth capital rather than true venture capital. And that's great. That works for a lot of people. But then who invests in the early stage, right? So if I've got a great innovation, who do I go to? And there, what we've seen consistently is backing from people that, I mean, ultimately this is an investment. Who wants that holding period? Who's willing to take that risk? And the answer is generally family offices, angel investors, high net worth people that have made their money from that sector. So we consistently see interesting innovation that has been backed for several years by high net worth individuals from the oil patch, right? Mm-hmm. That's where they made their money. So they wanted to deploy part of their wealth into innovative technologies within that sector. And it's filled a very important gap because, frankly, where there used to be several venture funds that only played in that early technology space, they just don't exist anymore, right? Yeah. They're few and far between.
But it's interesting. Oh, go ahead. Sorry.
I was just going to say, I think Dheeraj and Corey are exactly right. I do think that if you're, I don't know, British Petroleum or Saudi or Aramco, you need some innovative companies around when things go south, right? Because you acquire them, you morph, you absorb them, and so on. And I think Saudi Aramco's taken a very forward-looking stance here. But I do believe, coming back to the long sales cycles, et cetera, technology cycles, high investment, that there is a new ecosystem model that will emerge. I'm going to butcher the analogy, but sort of like Y Combinator, where large companies sort of give smaller companies more access so that they have a shot at surviving, for a later time. And in fact, this is something that Carl Koster and others we've been talking about. But just imagine if you created an ecosystem where large companies fill the vacuum left by the carnage of the tourist season of 2010, right? I do think there's a possibility there. And corporate venturing, I think, especially in this space, will take on a new shape.
Lou?
Lou Carranza of the MIT Energy Initiative. So you often hear successful entrepreneurs of successful companies say that the company they ended up with wasn't the one they started with, or they intended to start. And is that still true, or does the intense focus of investors and advisors somehow change that, and how flexible do you need to be, do you think, or how flexible have you been as you've started this? So both sides of the question would be great.
I mean, I think, it's the Lewis and Clark path. You don't know how you're going to get there. It's unpredictable, but you got to find a way, and great entrepreneurs find a way to pivot and find the best product market fit. As I said earlier, I think most companies fail because they never get to product market fit.
Or you have to find Sacagawea.
Or be nimble and proactive and willing to change, that you accept from each of those experiences that you encounter that you're going to get closer to that product market fit. And once you nail it, things take off. And we've seen that, and we've seen the other side of it too, where you're constantly solving Mother Nature problems, right? It's always challenging.
Well, some of the companies here have done pivots really as you've gone, right? So how would you respond to that question? I'll throw it to the entrepreneurs here. You've clearly done a pivot on you're starting out looking for fracking, and now you're onto nuclear. So.
Right. It's like how several people here have alluded. It's about focus too. That was a really hard decision for us when the nuclear power plant called us up. We knew nothing about that industry. We knew nothing about that market or that space. And they said, we really need you to come out here. Please help us. And for us, it was an interesting decision, because it was at a time where before we had really fully fleshed out this the tracer application in oil and gas for kind of helping and speaking towards productivity and monitoring, and it was more on the environmental monitoring side of things, which relied on liability issues. So we weren't getting as much demand from that, at least from the oil and gas producers themselves. But we saw that this was a market that had not just the need, but a very urgent want in nuclear. And we, after kind of thinking about it, although it was a very small market compared to oil and gas, this is one in which they really tend to share a lot of the best available technologies with each other, particularly with health and environmental and safety. And for us, now that we are working with Dominion Resources, they've really been sort of the company that's kind of provided the opportunity to do pilot studies, demonstrations, which has been really key for us. So I think we've managed to find ourselves in a really great fit, and one in which we know now that's going to be our immediate focus before we go on to further developing going back and exploring the oil and gas application. So we got pretty lucky there, I think.
Are there any other?
Yeah, we're sort of going through this right now, where we try to be very focused and yet still be seeing opportunities and ready to be opportunistic, and a lot of that is kind of learning from the customers that we're talking to, and the example with Alteris is that we're providing an energy product, but we're providing it to customers who oftentimes lack energy infrastructure as well as communications infrastructure, otherwise have very high logistics costs to do whatever they need to do in these remote areas. And so from these conversations with customers, we began looking at, well, can we use this platform not only to provide energy, but to provide telecom services, to provide surveillance services, to provide environmental or scientific monitoring services. And as we learn more, this is becoming more and more attractive. And so now we're going through that process of learning this new market. It's a new industry for us. And balancing how many resources we're dedicating to evaluating this opportunity versus focused on kind of the core product development effort. But it's a really difficult choice, because it's a huge potential market and something that really could drive adoption of the product in the telecom market in particular, in places like India, where there's a lot of effort to extend internet connectivity, and we've got a product that can adapt well into that market, but we're going through the process of sort of figuring that out and making that decision.
Kimberly, I think we have time for one more question. I'll turn it to Kimberly.
Hi, I'm Kim with the NECEC Institute, sister organization to the New England Clean Energy Council. And the vast majority of the entrepreneurs that we work with throughout New England and New York target utilities or municipalities as their primary customer. And in addressing the issue of the customer market fit, they're dealing with a customer who's extremely difficult to access. Do any of you have some suggestions or ideas about how to engage the utilities or municipalities to participate more in that conversation? And to what extent is this an insurmountable barrier as far as the innovation track is concerned? The timeframes are so different. The mentalities are so different.
I think we have some. I mean, Tom, you're
Sure.
front and center in that. And then trying to deal to Dan rather.
I actually don't think utilities are very difficult to sell to at all. I think if you haven't sold to utilities before, you will never get a deal in your life unless you do it with somebody who's done it before. But once you know the cookie cutter model for selling to a utility, it's actually very straightforward. You can accelerate their sales cycles, and you can quickly get them to become a pilot partner in the 100 to 500K range, and then quickly expand that after a year into the high 6, low 7-figure range.
And the secret is?
The secret,
Johnny Walker?
Well, there's a couple different secrets. It's not any one particular secret. The first is to understand the regulatory pressures. Everything when it comes to efficiency, renewables, anything that the utility is doing is simply the result of a regulatory pressure. And so you actually don't sell to the utility, you sell to the regulator. And the regulator then starts calling up the utility, and that's when the utility actually starts taking your meetings at a higher level than just the program manager. Then you figure out where the budget is. They say, oh, you listen to them. They say, here are our needs. You kind of package your product to fit their needs, and then they say, okay, this looks great, and they put you in a room with 5 different departments. Every department wants what you have, but they want another department to pay for it. That's when you have to go above the head of those departments and figure out who actually has the money to spend and who can spend it quickest. So with utilities, for an early stage company, it's about how do you accelerate time to contract, right? Because they will talk to you. In my last company, the longest it took me to get a deal was with Southern California Edison. I had a $1.3 million annual contract with Southern California Edison. From the moment they told me they wanted to do a deal, not a meeting where like, oh, this is cool, we like it. From the moment they told me we are contracting you, you've won the bid, we've accepted your bid, it took 33 months to sign the contract. The quickest contract I ever got was from the first meeting to a signed contract with Detroit Edison, which was a 5-month time frame. And so you learn quickly the tools of the trade for creating the right pressures to accelerate time to market, and then you have to make a decision. How much do you care about getting it out there early, just start generating data, have a customer reference, versus making it a bigger contract? Typically, for a company like ours, you want to get the first 6 utilities you can find to test this thing out, and they all start talking to each other, they start presenting at conferences. You don't care about the money. You care about the data that you're generating, and you care about the reference, and you care about exceeding their expectations wildly. Once you do that with 6 customers and you have independent evaluations out where somebody else that you haven't hired or paid is saying, this works, it's better than X, Y, and Z, we can statistically or economically verify it, it's very easy then to turn those 6 customers into 18 very well-paying customers by having a combination of 2 bifurcated sales teams, a sales team going into the regulator, and then a separate sales team, not the same people, going into the utility. And you don't call your regulatory sales team a sales team. You come up with a different name for it. And it's a tried.
What name?
It's a tried. There's many.
Success officer.
Many different names
professors.
for it. We call it policy analysts, senior policy analysts, things like that. But they're salespeople, and they're trained as salespeople. And if you do that well and you crack the utility nut, the reason why we're all selling to utilities is because there's a huge amount of money. Huge market, it's rapidly growing, they have to buy this stuff, they need to meet these challenges, there's no other option for them, and they're willing to explore new and innovative ways if you come at them from the approach of, we've done this before, you can trust us, we're not some random, we just raised $1 million from friend and family startup, and we think we have a good idea. You have to package it and make it really easy for them.
So Dan, you're also in this space for this
well,
utility.
we're working with Constellation to be a part of their EME program. It's called Efficiency Made Easy, which is on-bill financing, and that's pretty exciting to us. I think twofold. Number one, it's consistent with what we're trying to do in the marketplace as a whole. Number two, it's marketing and it's validation in a large territory with a huge number of customers. So we've toured Constellation through the University of Pennsylvania. We're in 20 buildings at the University of Pennsylvania. We were Penn went through an arduous process. They analyzed 35 energy conservation measures, ECMs, and Air Acuity finished as the #1 ECM that Penn could deploy across their entire campus.
Even better than lighting?
Even better than lighting, wow. Absolutely. And
that's
I'm a former lighting guy.
That's a tough one.
I know lighting very well. So yeah, we can make a significantly larger impact than lighting across their campus. So with that being said, really where we interface with utilities is really more on the incentive side, rebates and incentives. But becoming a part of an EME program, I think, is really exciting, and I just mentioned it. I was experienced in California a long time ago, and primarily it was used for lighting, for on-bill financing programs. But Constellation, I don't know, I think a lot of utilities tend to be me too, but if this, they're looking at a wide variety of ECMs and energy conservation measures to deploy through this EME program. And my joke of all this is I kind of like, our industry needs a sign and drive. If you're familiar with the Volkswagen commercials, we just need to make it easy for the customers, because I can tell you they want to do this. They really do. They just want an easier way to do it. And some of the PPA agreements, they have a difficult time buying them because they're this thick, and they're even arduous for them to get through the contracting process. So just a lot of this is the convergence of some simple buying and simple ways to buy validated ECMs customers want, and they want to get after it more easily. And I think that's where the marketplace is going. So I would just make people aware that there's these programs out there the utilities have. Investigate them and try to figure out a way to piggyback on top of them, ride the wave. They're a great avenue if you can get in with them.
Let me thank you all. This has been a remarkable panel to hear insights and experience in one place. It's just remarkable, and several things I'm taking away from it. But one of them is a reminder of what my dad, who was an MIT man, said. The customer's not always right. So it's learning that discipline that you mentioned and what you talked about in terms of who is the customer, knowing who that customer is, being nimble and responsive, finding a new application, perhaps turns out maybe it's a different customer, that focus on the marketplace and that relentless focus and discipline on the marketplace. The second thing I think one of the big lessons I take away from this is that approach to innovation in view of the capital market constraints and the long lead times and all the constraints that were talked about. I think each one of you is, in your own way, has discovered a niche that is a place where your solution is in a Clay Christensen way just good enough to give you a toehold to then move to scale. So we're moving away from the world of trying to boil the ocean with big capital solutions and really trying to find enabling solutions that are practical, that can generate revenue, generate that experience curve, and then move up to the market. So I think that we're seeing here a shift in the evolution and the thinking around how we're going to build this. And the third final point I'd make is that, just to bring it back to the comment about the romance of engineering, and I think that was I wrote that down because I thought it was a beautiful expression. I don't know if that's something that's talked about here at MIT a lot, but it's the first time I've heard it. But the excitement of what is possible here, and just to bear in mind, why are we in this game in the first place, right? Because we are really changing the world. These are early stage solutions that in 50 years, when they move to scale, are going to be transformative. But it isn't going to be in the Google sense. It's not going to happen in 3 to 4 years. It's going to happen 30 or 40 years. But the payoff, the prize, if I can use an expression from Dan Yergin, is so great in terms of the quality of life in our world. It's just worth what we're all going through. And I think I want to commend all of you on this panel for that, and thank you for sharing yourselves and your ideas with us.
So as we're briefly rounding this up, I just wanted to also thank the rest of the panel and thank the audience for being active participants. One more thing. So all of us, I think, learned a few things here today. I've certainly, taken down a few things. Don't forget to share with those who were not in the room. We have chosen for this format a very, very small and concise little format here where, we really are trying to bring together industry that are members, of the ILP program. We're bringing together a lot of startups, and we're also bringing together the MIT community overall. So please, I was serious when I said get to know a startup founder, but I'm also equally serious, get to know an MIT faculty. Take them to lunch. The meat here, take Sanjay to lunch. The meat here is in the exchanges. So take someone you don't know to lunch and use this as the spirit of what it's intended to be. This is not just any other workshop. We're trying to build a very concise cluster here around the energy innovation, around MIT and energy innovation, and try to use it that way. Next month we have, as Carl has already announced, we have food tech innovation on the 22nd of April. We're running monthly events. Spread the word about those, please. Again, thank you to the panel. Thank you to our wonderful moderator. I, for one, think we got a stellar lineup this event, and thanks again for making that possible. Carl and everyone else, have a safe trip home. And for those of you who I have promised to do more for today, and if you are a startup and you haven't talked to me, I have something else for you today. So just come see me. Thank you.